Right, morning guys. This is going to be a short video looking at task 10.10. What's interesting here, guys, is that additional asset has been purchased during the financial period. So that's something to note in this question, which we'll have a look at shortly. And then the other thing is you'll notice that there are balances, okay, which is different to the previous task that we dealt with. Okay, so just starting off again, guys, when we deal with adjustments, nice little thing to do is to always identify the accounts that are involved. That'll help you understand what side it's going on, debit or credit side. So in this instance, we're still dealing with depreciation. And with depreciation, we need to create that new account called accumulated depreciation, which is that contra asset account, which is going to offset that value of that asset for depreciation. And remember, no payment is being made for this depreciation. That's why we have to create a new account called accumulated depreciation. All right, so you need to just identify your accounts involved in your first step. And if you do that going forward with the new adjustments we start bringing in over the next couple of weeks, it makes your life a lot easier when you actually can identify what type of account it is before you start. Okay, because then you can just understand it a lot better. In this question, you'll see, guys, is they gave us vehicles and equipment at cost. Okay, remember that is that GARP principle there, which they refer to as the historical cost rule, where we always reflect our assets at the original purchase price, at the original value. Okay, so that's the historical cost rule. And then you'll note as well that the amounts were given to us here. The accumulated depreciation amount for vehicles was given, and also the accumulated depreciation on equipment was given to us, 37,940. That equipment accumulated depreciation amount, okay, is the one that we're going to need in this exercise, because you'll see the vehicles is depreciation on vehicles is done with the straight line method or fixed installment method, and that the equipment is the diminishing balance method. So you'll see that 37,940 Rand you will need when you calculate the depreciation for equipment. Okay. A financial year, guys, again, I know it has been touched on, but it's 12 consecutive months. In this question, the financial year is from the 1st of March 20.8 through to the 28th of February 20.9. Okay. The GARP principle that we're using here for this adjustment is it's the matching principle. And what that matching principle tells us is that we basically must match all our incomes and our expenses to that financial year. So the adjustment we're making here is on depreciation, okay, and that depreciation expense must be matched to the financial year that we are in. So you'll see now I'm going to draw up a timeline, and we'll do a nice illustration of how that looks, and that'll hopefully give you guys also better understanding for when we get on to the next adjustments as things get more complicated. Right. So starting off here with the depreciation on vehicles, again, it's the straight line or fixed cost method. Okay, so that's obviously something that is important for us because we know that the two different methods that we deal with regards to calculating depreciation. To begin here, you had the balance at the end of the financial year for vehicles was 550,000. The information told us that during the year in December, additional vehicle B was purchased for 160,000. So before you start this question, you need to calculate what vehicle A was at the beginning of the year, or the amount of what the amount of vehicle A was, which is 390,000. Okay, so we've got two vehicles here. Vehicle A, its cost was 390,000, and we've had that for full year. So the calculation there will be timesing that by 20%, and then it's because it's a per annum rate. Yeah, it's for full year, and that's why I've just shown that they're timesing it by 12 over 12, which is it's going to be 78,000. And then for vehicle B, you'll see here its value is 160,000 Rand. But the thing with vehicle B is we haven't had it for a full 12 months. And that's why you'll see we actually times it by 3 over 12, because vehicle B, we've only had it for 3 months. So the portion there for depreciation on that vehicle B is only 8,000 Rand for those 3 months. Okay. If we then have a look at this in a timeline, which is what I suggest we do from now on, is when you deal with adjustments, you always draw a timeline for yourself, and then you can obviously have a look and see where it fits in to that financial period. Okay, so if you have a look at this, vehicle A is bought at the beginning of the year, so that value of 360,000 Rand is for a full 12 months. So if you look at that calculation, so 390,000 Rand for a full 12 months, timesing that by 20%, and then obviously because it was for a full year, 12 over 12, which is 78,000 Rand. Then, of course, if you look at vehicle B, we only had vehicle B for 3 months. So you'll see there, we times that 160,000 Rand by the rate, 20%, and then 3 divided by 12, because it was only for those 3 months. So you'll see now that the total depreciation of vehicles amounts to 86,000 Rand. So gents, like I've said again, draw yourself a timeline when we deal with more complex adjustments. By having a timeline on a piece of paper in front of you, you're able to understand it a lot easier. So I suggest from now on that we make sure that we use a timeline. Okay. In calculating depreciation on equipment, guys, it's the diminishing balance method. So what's happening here is you need to find or calculate the new carrying value, okay, after deducting the accumulated depreciation on equipment first. So you can see the original cost was 140,000 Rand, and that accumulated depreciation for that period amounts to 37,940. Okay, that must be deducted first to get to a new carrying value of 102,060. Once you have the new carrying value, you then times that by 10%, and of course it's a per annum rate, and it was for a full year. So you get your figure of 10,206 Rand. Okay. In recording this in the general journal, in our next step, all right, we've already dealt with that recording to the general journal, but you can see depreciation amount is the two accumulated amounts added together. And of course, that vehicles includes vehicle A and B, and then we've got our accumulated depreciation equipment there. So that's pretty straightforward. Okay. In the general ledger, like I said at the beginning, there are now balances. So you'll see vehicle A, its balance was 390,000 Rand. The equipment balance, I see the solution, it should show it as the 1st of March 20.8. The equipment balance is 140,000 at the beginning. We then had balances here for accumulated depreciation on vehicles, and we had a balance there, accumulated depreciation on equipment of 37,940, which we've dealt with already. Okay. Once we've done that, you'll see during the financial year, an additional vehicle was purchased in December. So that's the 160,000 Rand there. And then you deal with, at the end of the financial year, you deal with this adjustment for depreciation. And you can see how we record that, okay, and how it's been recorded there. So guys, I'm hoping that's a nice little short video, and that'll give you guys a good enough explanation to obviously have a better understanding of all of this. Thanks.